Well, we're really doing what we always do. I mean, we look at this current economy as just, I mean, yeah, it's a mess, but the markets are always changing and the economy is always changing. We did this back in 2000. Between 2000 and 2002, we had a meltdown just like this. And actually, if you go back and look at market history, there's been 34 bear markets over the last 100 years where the market's gone down. And as I mentioned earlier, 1 out of every 3 years, the market is going down. So it's something that you always have to deal with. And the way that you deal with it from an investment standpoint is you figure out which areas of the market perform the best after a market meltdown. And then you position yourself in those areas of the market. So you turn something that is bad, a market meltdown, into something very positive. Because if you're positioned in those areas of the market that come back the fastest after a down market, now all of a sudden you're able to benefit and capitalize on a bad situation.
Most firms right now, with what's been going on in the markets, they usually have a static approach to the markets, and they have a certain allocation to stocks and bonds and things like that, and they won't change that allocation maybe over time. But what we'll look at right now is where we can add value to a client is we take a look at where we are maybe in the economic cycle. Right now, the economy is, most people, there's a consensus that the economy is bottoming out and it could be turning, that we might actually be coming out of the recession. Now, a lot of people don't believe that, or they're not sure of that, and you never know at the time. Like right now, you never know until 6 months, a year down the road whether we've really come out of the recession. But one thing's for sure is the markets are always looking ahead, and they've priced in the recession, and now they're pricing in recovery. So what we take a look at is, well, what things do best coming out of a recession in your initial phases of recovery when the economy starts to recover. Certain things like cyclical stocks, materials, financials, energy will sometimes do better when you have the initial stages coming out of a recession. And so we have the ability where we're flexible enough, we can allocate more to those areas, whereas most advisors are not going to look at that. They're not going to be aware of what's going on, and so they can kind of be left behind. And so what we'll do is we'll allocate to areas that we feel have the best potential when you're coming out. You can kind of get the most bang for the buck, so to speak. And so we'll overweight certain areas. Like right now, we'll be overweight in technology, in materials, and things like that do the best when they come out of recession. And that way you get better performance on a relative basis than maybe if you were just in the S&P 500 in general. That way it adds value that way. Most people aren't going to be aware of what does best coming out of the recession. And then 6 months down the road, that dynamic will change and other market leaders will come up to the top, and then we can get on those as they move. So it's as the market moves, you got to be able to move with it. And if you're not following it yourself all the time, you need someone that can do that for you, rather than just an advisor that's maybe doing nothing but looking at your portfolio once a year. I think you need someone that's monitoring it on a consistent basis.
If you're interested in learning more, I'd recommend that you contact us and request a complimentary portfolio review. That way we can look at the way you're currently invested, and we can make recommendations on ways you can improve that going forward.